Hi, my name is Antonio Gastelum, and I'm a partner at Meg International Counsel with offices in San Diego and Houston. In today's video, we're going to talk about the two most important estate tax deductions in the United States. Join us. The computation of the estate tax is generally determined according to the net estate after the person dies. This calculation uses a formula that allows the use of certain fixed exemptions provided by law and of other deductions for outstanding debt at time of death. With regard to exemptions for U.S. citizens and residents, legal or undocumented, they each have an exemption of $11.4 million as of today. This exemption, however, shall be modified again to lower it to $5 million starting on 2026. This exemption will continue to be indexed to the annual inflation beginning in 2013 as if there had been no modification at all. On the other hand, the exemption for foreign non-residents only have an exemption of $60,000. This exemption is not foreseen to be affected or modified in any way. Inasmuch as the deductions are concerned, the two most important and valuable deductions for the computation of the estate tax are the unlimited marital deduction and the mortgage debt deduction that may exist over property they used to own. What is the unlimited marital deduction? Well, the unlimited marital deduction allows two spouses while alive or the estate of the decedent to transfer all of their assets that exceed the legal exemption, free of federal taxes, to his or her spouse or the surviving spouse, as long as this spouse is a U.S. citizen. That is to say that every person, whether American or foreign, subject to U.S. estate taxes, can transfer all of their assets in the U.S. while alive or after the death to the U.S. citizen spouse with whom they were married, free of federal taxes, or rather, tax deferred. This tax deferral lasts until the death of the surviving U.S. citizen spouse. Conversely, if the spouse that receives the assets during the life of or that survives the transferor is not a U.S. citizen, then the unlimited marital deduction may not be used as such, and then a qualified domestic trust, or QDOT by its acronym in English, or another strategy would need to be used to accomplish the same objective. Second, how is this mortgage debt deduction calculated by a foreign non-resident? Well, generally, for citizens and resident aliens, the mortgage debt reduction is quite simple to take at the time of computing the estate tax, because all they need to do is to take the amount owed on a mortgage at the time of the death, deduct it, and presto, there you have it, you're done. For foreign non-residents, however, to be able to take the same deduction on a mortgage over property located in the United States, one of the following two assumptions need to happen. First, that the mortgage debt to be deducted is non-recourse debt. This means that the creditor will only look at the mortgage asset and not the individual owner to satisfy the debt in case of default. In this case, the debt will be 100% deductible on non-recourse debt. Or the second assumption is that the mortgage debt to be deducted, even if it's not non-recourse debt, the debt is itemized and included in the appropriate return, along with all the rest of the worldwide assets and their appraisal of the decedent. This means that the decedent or the estate of the decedent will have to appraise everything that the owner, the foreign owner, had in and outside of the United States, and appraise the property and then itemize each of the properties and values. So while this, you can imagine that it's expensive, it also takes a lot of time, and it also takes, some people just don't want to either spend the money or to I should say, they don't want to disclose all of their assets outside of the United States. So therefore, they don't want to do that. Now, in this second case, the mortgage debt may only be deducted in the same proportion that the U.S. assets has in relation to the rest of the worldwide assets of the estate. That is to say that if the U.S. property represents 10% of the value of the worldwide estate, only 10% of the mortgage debt will be allowed as a deduction. Generally, when the cost-benefit analysis is made for taking the mortgage debt deduction, the majority of the foreigners prefer not to take this deduction. There are other deductions, such as those made to charity donations and tax credits that can be used, but generally they result in a much lower tax impact compared to the tax to be paid. And this is because most of our, with the unlimited amount of deductions, you can transfer all your assets over. And number two, with the mortgage deduction, usually our mortgages are our most significant asset in our estate. So it's the largest amount that can really impact our estate generally. So that's why it is important to emphasize that certain also free transfers made within 3 years of death of the donor decedent are not deductible from the estate tax. And this is important because what the IRS or the government doesn't want is somebody transferring all their assets while they're alive just so they can avoid the estate tax. So any transfers that you make that are free within 3 years of death are being taken back and being reverted back to the estate and considered for the estate tax. Now, if you pay taxes or gift taxes on that money, on those assets, then the tax paid will be considered at the end of the formula. But nonetheless, all assets transferred within 3 years of death had to be reverted back to the estate and for purposes of the computation of the tax. Okay, so I hope you enjoyed this subject for today, and hopefully you can join us for the next video. Thank you.